The Institute of Banking and Finance, or IBF, was established to foster and develop the professional competencies of the financial sector. IBF is dedicated to empowering practitioners with capabilities to support the growth of the Asian financial industry. It is the national accreditation and certification agency for financial sector competency. Developed by the industry for the industry, IBF Standards is a set of competency standards benchmarked to international best practices. IBF's vision is to be the Asian standard of excellence for practitioners in finance. IBF Standards covers 13 industry segments and offers a wide range of development roadmaps. IBF Standards offers accredited programs to guide a financial practitioner from licensing examinations to professional certification. IBF Standards certifies financial practitioners at 3 levels. An IBF qualified individual is one who is equipped with a broad base of capabilities and foundational competencies to undertake new roles. An IBF advanced individual is one who has acquired applied knowledge and complex analytical skills for specialists or leadership functions. An IBF Fellow is an industry veteran who has demonstrated professional mastery and exemplifies thought leadership and commitment to industry. The IBF certification mark, a set of parallel elevation bars, symbolizes the close partnership between IBF and the industry. IBF certification is therefore an industry-endorsed mark of quality that recognizes individuals who exhibit professional excellence, integrity, and commitment to the industry. Be part of the IBF community of certified financial practitioners. Participate in continuing professional development programs. Avail yourself to learning resources to plan your opportunities for mentoring and networking. IBF, the Asian standard of excellence for practitioners in finance.
The digital world is ever-changing. With more than 20 years of experience in serving the investing public and the financial services industry, Cybercode has been providing financial training and information technology solutions for established clients. Cybercode is based in Singapore with 7 offices around the globe and continually expanding. Being ISO 27001 certified and having a proven reputation for service excellence, Cybercode endeavors to build long-term relationships with customers and business partners alike. Our services include, but not limited to, the following: investing public, to provide training programs to the public, such as investment and stock trading courses. Financial professionals, providing up-to-date training courses for the finance professionals, keeping them well-informed with compliance, regulatory requirements, financial products, and best practices. Financial technology. We develop and provide information technology solutions and management services, curated specifically for our clients' needs. Cybersecurity and data. We provide data, information, analytics, and cybersecurity services to your business, keeping your data safe. Since our inception, we have trained thousands of participants among the investing public, financial professionals, hundreds of B2B clients, and have continued to forge strong business partners. To find out more about what we do and how we can help you, contact us today. Cybercode is a leading financial training provider and a leading developer of information technology solutions and management services.
Good evening, ladies and gentlemen. Thank you for tuning in for this Thursday evening webinar session of the webinar titled Unveiling the Dividend Stock Seizing Opportunities in the Post-Interest Rate Cut Environment. Our keynote speaker, Darren Chew, Senior Financial Services Director from Philips Securities, and also IBF accredited trainer who teaching 2 different courses, Lifetime Income Mastery course as well as the Risk Analysis course, since about 4 years back, more than 4 years back, and as well as associate trainer with Cybercode. Now, do allow me to do a short introduction of the keynote speaker, Darren, as well as the company. And of course, for those who have been following through with CyberCode since 1996, we get to know that CyberCode, we start off our business providing a financial investment courses to the retail individual. This investing and trading courses, right? And that's for the B2C level. And then for the corporate level, B2B, we also provide the IT security courses, cybersecurity and CPD courses, right? And then we all aware about it, I think exactly 4 years back in 2020, when this COVID pandemic hit Singapore, so as a whole worldwide. So that is a time where IBF coming aggressively to open up for this and then to help out local citizens and permanent residents to open up the courses for local training provider to provide to the this local citizen and permanent resident. So we are quite proud to say that CyberCode quite proud to say that we are garner one of the highest number of the IBF accredited courses. So in fact, 2 of the courses, lifetime income mastery course, as well as the risk analysis course, is actually tutored by Darren Chiu, our senior financial services director, will be shared towards the end of session. Now, today, if you join as a citizen or permanent resident, you can get up to 70% of the cost fee subsidy. So for local citizen, you have your SkillsFuture credit, even you can use your SkillsFuture credit to fund for it. So this will be more detailed towards the end of session. Myself and Darren going to share with you how can you benefit from that. So please stay tuned to the end of it. Now, of course, we talk about a little bit of keynote speaker, Darren, our senior financial services director. Now, in this Darren, before he joined Philips Security, I think this year will be stepping into his 18 or 19 years this business with Philips Security. So right before he joined Philips Security, he's an engineer, born by engineer. In fact, I think 18 years back, he decided to join Philips as a stockbroker, then taking a dual license, then promote to a financial service director, senior financial services manager, and then to currently a senior financial services director. I think currently he's taking care of more than 30 over trading rep, trading rep as well as a financial agent, we call FA, under his care. Now, he is also one of the franchise owner who services his client in Jurong East branch, which is the later part. Darren, you share more detail, right? Now, informed, of course, for this past 18 years, Darren also get quite a number of our colleagues. I think he's one of the member of top of the table, one of the highest level of those who can get in Singapore, right? So this is something that quite not many number of you in Singapore can do that. So a lot of things to learn from this 2-hour session, but of course we want to make it more interactive here. Now, if we do have questions within this 2-hour session, please feel free to post your question in the chat or in the Q&A. So in the appropriate time, of course, Darren will provide you the reply, right? So please stay tuned to the end of the session. Like I say, myself and Darren going to share with you how can you benefit from this lifetime income mastery course as well as this analysis course, right? So without much delays, I shall cordially invite Darren to take over the microphone. All right, Darren, please.
Thank you, Andy. Okay, good evening, everybody. Thank you for attending today's session. Okay, disclaimer, what I share with you is for knowledge and information only. It doesn't constitute any financial advice. Okay, do remember to do your own due diligence. Fast introduction about me, as Andy already mentioned. Okay, I'm Darren Chiu here, in case some of you don't know who am I. Okay, I'm from Philips Securities, and our team actually operate the investor center located at Westgate Tower, level 10. Okay, and I'm also a trainer for IBF accredited program. In fact, I conduct 2 IBF courses. One is called the Lifetime Income Mastery, and one is called the Risk Analysis course. So the Lifetime Income Mastery will have 2 runs first half of the year. One is in April and one is in June. Okay, and for risk analysis course, most likely will be on the second half of this year, but I have not firmed up the date yet. Okay, and I got a YouTube channel. You can subscribe to my YouTube channel, okay, where I got live portfolio there. And you can follow me on Facebook page, okay, as I will post other webinar that's not linked to CyberCode. Like for tomorrow, we're doing a Ask Me Anything about unit trust and ETF webinar. Okay, if you want to sign up, you can go to my Facebook page to sign up on that webinar. Okay, this is the final slide about me. Senior Financial Services Director, okay, from Philips Security, and our team operate the investor center located at Westgate Tower. We call ourselves the Jurong East team. Okay, I work as an engineer for 10 years. And after that, I made a career switch to this industry about more than 18 years ago. Okay, and thus, if anyone is exploring career switch, you can talk to me separately. I'm also a qualified member for the top of the table. That's the highest qualification an advisor can achieve in this financial industry. Okay, so now today we're going to talk about Singapore stocks. Okay, Singapore stocks. With the interest rate cut coming in, we're going to talk about Singapore stocks. And thus, you got any question regarding Singapore stocks? Okay, you can post it on the chat group. Okay, then I can go through it accordingly. Because the time is short, I can't talk about all the 600 over stocks listed in SGX. Okay, so I'll pick a few just to talk about. And because we know that interest rate is expecting to cut, okay, and when are they going to cut? Nobody knows. Okay, nobody knows. But the probability of they going to cut this year is high. And the question now is how many times? Okay, how many times they will cut, and by how much percentage they cut? You see, when they cut interest rate, the quantum of cutting is 25 basis points. Although I don't know what 25 basis points. 25 basis points is 0.25%. Okay, so when the interest rate is cut, okay, what is the impact? Okay, impact to the market as a whole. Okay, first, those companies that are on borrowings need to grow on high borrowings one, they will definitely benefit from the interest rate cuts. Okay, for example, REITs will definitely benefit from the interest rate cut. Okay, however, I have another separate session I think I do last week talk about REITs on interest rate cut. So today we'll focus on the stocks, because if I put REITs and stock together, I think not enough time also. So that's one part. Another part is companies that are on high debts. Okay, like for example, property sectors, they are on high debt side, then they will indirectly benefit from all those engineering corporations that have high level of debt because they pay lesser interest. Okay, and some companies, they want to grow, the cost of borrowing will come down, then they can borrow to grow their business. So interest rate cut is a good news to the market as a whole. Okay, as to the market as a whole, and thus we're going to explore the opportunity there on the stocks on that. Okay, but my key focus is not really on capital gain for Singapore stocks, because Singapore stocks are mainly for dividends. Okay, so I focus on opportunity for dividend related. So the first sector we're going to talk about is called banks. Okay, why banks? But we know that when interest rate rise, everyone says that interest rate rise is definitely good for banks, because banks were able to charge higher loan, all these things. Okay, but on the other side now is bank need to pay higher deposit rates also to us. Okay, in order for us, they expect us to put the money with them rather than put the money into the stock market. Okay, they put the money in the stock market so that they can borrow at higher cost. So what I call is the margin. That's called the net interest margin. So when we talk about bank, we're talking about something called net interest margin. Okay, that's where the profit of the banks come from. So what about when interest rate cut? Okay, is it a good thing for the banks also? You can say that actually banks interest rate up, interest rate down, both are beneficiary to them also. Because when interest rate come down, they will cut our savings rate, they pay us less interest. But of course, when they borrow out to the outsider, they also borrow at a lower interest rate. But because of lower interest rate, more company can afford to borrow. They can afford to borrow from the banks. And although at a lower rate, but because of volume, so bank is still very profitable. So ultimately, it depends on how the bank manage the net interest margin. It's the gap, okay, between the borrowing rate and the rate they pay to us. Okay, then there's a gap, and that's where their key profit is. Okay, that's one part. Of course, they got another part is their non-interest side. Is we go to bank, they sell insurance, they sell investment. That one has nothing to do with interest rate already. Okay, but also when interest rate come down, there's another business bank will do, it's called premium financing. They ask you to buy an insurance plan, borrow money from them, they lend you money, or they ask you to buy a unit trust. You say that I got only 200,000. They say I can lend you another 200,000. You go and buy 400,000 worth of unit trust. Because of lower interest rate, people are more willing to leverage on that. But currently, you want to leverage, it like don't make sense, especially those retirement plan. It don't really make sense to borrow at this rate. Okay, because the return, you don't see money. Okay, so for banks, Singapore is quite simple. In a way, we only have 3 banks: DBS, UOB, and OCBC. So a lot of you ask me which bank is better. Okay, so now let's look at performance of the banks. So these are the 3 banks. Okay, I benchmark the banks against who? STI ETF. Okay, I don't benchmark within STI. I benchmark against STI ETF. As STI, you cannot invest, but ETF, you can invest. Okay, ETF, you can invest. So a lot of investors say, I must well buy STI ETF. And we know that STI ETF, more than around 50%, the weightage comes from the 3 banks. Okay, it's come from 3 banks. And how does this 3 banks perform against STI ETF for the past 1 year? You can see the runaway leader. This is who? It's not DBS, no. It's OCBC. Okay, 039 up the 15 point. This is total return, include your dividends. Okay, followed by who? Then followed by DBS. Okay, followed by DBS. Then followed by UOB. UOB is the worst performance among the 3 banks in the past 12 months. Okay, in the past 12 months. But all 3 banks are better than you buying STI ETF. Okay, yeah, better than buying STI ETF. Okay, but this is 1 year. 1 year doesn't mean anything. Let's look at longer term. 5 years. Okay, let's look at 5 years. Then in 5 years, you see the leader change. DBS become you can see all come down at the same time. Now it's who recover faster during COVID. And DBS is the outright winner, okay, with a 73% total return over the past 5 years, followed by OCBC and followed by, but UOB ranked last. Okay, UOB ranked last. Okay, and STI ETF is here. Okay, this is why I always tell clients, no need to buy ETF. You just buy counter that's better than the ETF. Yeah, you're always better. Okay, you're always better. So banks is a big stage on ETF, but you can see the bank, you buy any bank stock, performing better than STI ETF. Okay. Now, okay, let's look even longer. Let's look at if you're a long-term investor. So retirees say that you buy banks. As I also advocate that for Singapore stock, if you're a retiree, okay, there's one counter you need to have in a portfolio. It is the banks. Okay, it is the bank stocks. Singapore only have 3 banks, so it is the bank stock. In US market is a bit different because US market there are too many bank counters. But Singapore only got these 3 bank stocks. Okay, and this is a long-term wise performance. Okay, long-term performance, DBS is the runaway leader. Okay, by runaway, you can see that the gap only start to come in here after COVID. But before that, all the 3 bank performance are pretty together, pretty intact. It's just that DBS suddenly get the runaway. Okay, runaway leader on here and become the best performance. Okay, that is since 1st January 2008. That's since before the global financial crisis. So here also tell you something. This is the global financial crisis. So for those that have been to the global financial crisis, you may think, wow, that one is really crazy. But now you look it back from the stock chart perspective, what is global financial crisis compared to the bank now? Okay, but you look at it compared to STI. Okay, like never recover. Okay, like never recover. So there's something on that is for portfolio buildings. I personally feel that the banks will be a better bet. Okay, a better bet on that. And the question now is which bank? Okay, which bank? All 3 banks, the dividend yield is pretty attractive at this juncture. It's about 5+%, minimum 5%. Okay, minimum 5%. And the next question is asked: is it sustainable for the bank to continue to pay at this dividend yield? Okay, because their dividend have been increasing, and DBS has started to pay quarterly, and this is why it's the first to pay quarterly, and thus it shoot up. And it's the first bank that paid dividend for more than $1, $1.20. I remember quite some time ago. Then suddenly the bank price shoot up. Because human being is a bit different, is that look at values. DBS pay 120, OCBC pay how many cents? Okay. So wow, to them 120 is a lot, but you have to take in perspective. What is the share price of DBS and what is the share price of OCBC? It is different share price. One is $30+ and one is $13. You cannot expect a $13 OCBC bank to pay 120 in dividends, while $30 DBS bank still pay 120 dividend. It cannot be that way. Okay, and so that it must have that expected, because a lot of people tell me, wow, you see DBS pay me 120, 190, 150, but you look at the other two banks only pay me less than $1. Because the share price is a bit different on that. So that is something you need to take note in that perspective. Okay, now let's look at this bank. Okay, do take note, it is not a recommendation to buy or sell any stocks. Okay, but a lot of people ask me, will you want me to look at banks? I practically only will tell them that two banks, any banks is okay because all in the same direction. But I really want me to zoom in there, or keep mainly zoom into one of the bank. It's called DBS. Okay, one bank is called DBS. Okay, and it's under the market and you look at the dividend yield is 5%. Okay, so the dividend yield is a 5% thing, and the margin is quite good also. Okay, and next is that you want to look at this is something I just want to highlight. This is before COVID. You can see that their income, okay, their interest income. You can see that interest income is this one. Okay, then after COVID come down, then go down further, but then it start to increase so high, 28. Okay, from here. Okay, so the next question you need to ask, interest income. It is so high, okay, but okay, interest expenses also increase. So the net interest, so what you need to look at is called the net interest income. Okay, so this is the net interest income. Okay, so this is what you want to focus on. And actually, yeah, it really increased a lot. Because the interest rate increased compared to the way they pay the deposit, okay, the gap. So now is that when the interest rate will come down, okay, when the interest rate come down, do think that this thing, interest income will come down, okay, or go up. That will depends on whether people are willing to borrow more money, okay, on that. Okay, definitely more people will borrow money. For me, that my take is that the bank will still make good money. Okay, the bank will, but it is go up too fast already. So there is a possibility it will come down. Okay, it will come down, but unlikely it will go down to this level like you have to go. So there's a possibility to come down, and the net interest income, of course, the expenses will definitely come down. But this thing may have a possibility of come down for FY 2024, okay, or 2025. It's very hard for them to grow at this rate. Okay, grow at this rate. And thus, it may be negative to the stocks. Okay, so that is something you need to take note on that. Okay, but then you look at their dividend per shares. Okay, this is what DBS have been doing. So they have been very conservative paying. Then after they go to 120, FY18, then 19, 123. Then after that they cut dividend. Okay, they cut dividend is not because they want to cut. I think some of you been through COVID, you know that MAS asked all the banks to cap their dividends. Okay, ask the bank to cap their dividends. Say that now COVID period, don't pay too much. Cap your dividends. Okay, so you can see that they pay you 120. The payout ratio is 55. So they pay 87 cents. The payout ratio is coming down to 88. So in fact, that if they were to use the same payout ratio, they can supposed to able pay you the same level. So it's not really they can't pay you. There's a rule, MS rule. Then MS start to release the rule from the banks. Then they start to normalize the dividend and they start to go higher. Okay, and with a payout ratio of less than 50%, they can pay 192. Compared with a payout ratio of 56%, that's before COVID, they can only pay 120. Okay. And the question now is, can they maintain? As the bank, I think they will try to maintain it. Okay, but when they try to maintain, do watch out this thing, that this thing will most likely increase. This thing will most likely, because if their income drop and they still want to maintain this dividend, the payout ratio have to go up. Okay, but at a 50% payout ratios, to even to maintain that, but increase the payout ratios, they have done that before. I think it's still very healthy for the banks. Okay, it's still very healthy for the bank. And thus, long term I'm still bullish on DBS. There may be a spike, and you know that if they are offering bonus shares, okay, bonus shares, okay, you got 10 DBS shares, you got 1 bonus shares. So in that expect there may be opportunity. What do you mean? by that is this is DBS chart. Okay, you go to 36.4. A lot of times say, well, DBS go 30 plus, you can buy, and I tell them wait. Okay. A lot of people ask me what is a good price. I'll buy DBS. I always tell them below $30. Below $30, then they ask me, I'm sure DBS will go below $30. Not now, but there's a possibility we can. First thing that now is 34. Okay, now it's 34. Okay, and actually you can see the chart actually more towards a downside based on moving average. But if they were to do a bonus share issues, okay, there may be a knee-jerk effect, the share price will come down. Okay, but do think on that one, because the market is bullish. If their share price come down, a lot of investors don't know what happened. They'll just rush in and buy. They say, DBS on sale, 10% drop. Okay, don't be panicked also when you see there is a more than 5% sudden drop in DBS shares in one day, because that's where the bonus share come out. Okay, then you may spy fast because a lot of people may just rush in to buy. But usually when a bank issue a bonus shares, okay, let's say now it's this $34, right? After they issue a bonus share, the share price will drop. Okay, but after that, the share price will usually go higher than the price before the bonus shares did. Okay, unless the whole world go into recession. Okay, so that is on the DBS side. To me, it is a bank stock that you can consider for long term. Okay, but you want to have a good entry price, then you just need to wait. You say, I don't care, the long term okay, then wait for bonus share come, I just buy. Long term you go is okay, but you want to look for a more ideal case. Do think that US have not correct yet. So when US were to go for correction, would there be a ripple effect to Singapore stock market? They may have some. Okay, so maybe that will be opportunity on that. Right. So the next thing is $34 to a lot of people is a bit too costly, especially to young people. Wow, I only have $10,000. You ask me to buy 100 shares of DBS, is $3,400. It contributes more than 30% of my portfolio. It's a bit too risky. So is there any other alternative? Then that is where OCBC can come in. Okay, OCBC can come in. Okay, and OCBC happen to have a even higher yield, 6.11%. Okay, 6.11%. And all same, you can see all got a big jump. But OCBC jump even more crazy. Okay, 3 million to 20. Okay, more crazy jump. Okay, but the income, the total net income also got go up. So the next question is, there's a possibility it will drop. Okay, this one will drop, but I feel that the quantum of drop for this will be more than this, because for borrowing will pick up but will not be immediate. But interest rate cut is immediate. Okay, but long term they'll able to pick it up. Okay, and this is OCBC dividends. Okay, OCBC, they also follow DBS. I think they have no choice. DBS pay like that, they also have to pay like that up. But their payout ratio is slightly higher. However, it's still around the 40-50% range. So even if they want to maintain up, the most they raise up, I don't think the payout ratio will cross 60%. So it is still a very healthy thing. And let's look at the share price here. Okay, OCBC, the chart look nicer than DBS. It's still more on a slightly uptrend. Okay, uptrend basis. Okay, of course, stock will go up and down one, but it's still on a more nicer uptrend stock. Okay, and now it's 13.23. So I will say that I will just prefer to wait. If you die want to buy, maybe you can wait until you drop to close to $12. Actually, you can go below. Very hard for them to go to 11.2 now. We need a practical. If they can drop to here, that will be quite cause a lot of panic in that thing. So these are the bank stock, and I don't like UOB. That's why I look at the performance itself. It is not attractive already. Okay, and UOB for the past, you see 1 year, I do a 1 year, 5 year, more than 10 years performance over the 3 banks, and UOB constantly ranked the last. Okay, and for the past 1 year, they are flat. They are flat, more flatter than DBS. So if ask me to choose, I will choose these two. Okay, this is because the entry level to some of them lower. You got 10,000 for young people, got 10,000 portfolio. You buy 100 shares, less than 15% of the portfolio, still bearable. Compared to DBS, okay, it's 30%. And for those say I got 50,000, then the question is, you buy DBS share is 3,004, you buy OCBC is 1,003. Okay, even you got bigger capital, but if you buy DBS one share, if you want to do average in, okay, the quantum is big. But for OCBC, because the amount is lower, it is more easy to do average in. Okay, it's more easy to average. But of course, you got say I got 300, 400, 500,000 portfolio. Then of course, then no issue. Either one is okay. You can even buy two. You can even buy OCBC and DBS. So it's also based on the portfolio size to look at it on that. Okay, so that is on the bank counter that we look at. Okay, some of the stocks I may go on to talk about, but I may don't have the chart because there's too many stocks. I don't have time to prepare so many. Okay, and I also don't know how long it takes. Okay, next counter we're going to talk about is called this one. Okay, ST Engineering. ST Engineering is very debt heavy. Okay, it's very, very debt heavy. And you look at the ratios, actually it is not healthy. Okay, it is not healthy. The current ratio not even have 1. The quick ratio is 0.65. It is very, very, it is not healthy. Okay, it have a very high debt. It had a very, very high debt on that. But good thing is they got free cash flow positive, and their dividend is 4%. And also one thing is that the industry they are in, the industry they are in is a portion is on defense. Okay, so we're not gone one. Just as we look at Boeing, okay, BA, Boeing recently got a lot of issues, and in fact Boeing lose money, right? Okay, but Boeing, even they got this type of issue already. You look at Boeing drop compared to Tesla, I think that Tesla drop worse than Boeing. Okay, why is that? So is Boeing also is in got for those not where Boeing not only building aeroplane, no, Boeing also defense, okay, and is the world largest defense company. It's the largest, number 1, biggest. Okay, and this is why Boeing is still in the 1,000 component stock despite losing money, despite all the bad news. So unlikely Boeing will gone. Okay, because they got this something, a protection shield for them, defense. Okay, the US need them. Okay, because they are US. So for Singapore, ST Technology, the Singapore government need them. Okay, the Singapore government need them. Okay, so this is why even despite the ratio is not that healthy, okay, not that healthy, it is considered a defensive stocks. Okay, but it also considered boring stocks. Let's look at their revenue. Their revenue actually have went up, definitely have went up for this counter. But look at their revenue have went up, right? But the income never went up. Okay, so the top line had go up, but the bottom line had never went up. It is flat. Okay, and you look at the margin here, it is not high margin. Net margin only 5.81%. Actually, is very, very low. Okay, it is very low. Okay, but why did you put this thing in it? Because this company is SI component stocks. It's a major stocks in Singapore that banks, I don't think will collapse. Okay, this company, very hard for them to go collapse. I cannot say never, but very, very hard for them because of the defense. Okay, of the defense side, they got a lot too many things inside. So this is why you can look into it, and then you look at the dividends. It's a boring stock that pay flat dividend and they then just increase to 16 cents. Okay, and you look at the payout ratios. It is always above 80%. Okay, it's always above 80%. Practically means that it functions more like a REIT. Why I say that function? Because a REIT need to pay up 90% of their income as dividend. This ST Engineering earn already they pay out also close to 90% of the income as dividend, okay, of their income as dividend to investor, okay, and they are also debt heavy. They are also debt heavy, and thus the ratio will, I expect the ratio should improve, okay, when the interest rate cut, okay, when the interest cut, so the ratio will improve. When the ratio improve, as they constantly maintain this part, okay, maintain this part. So if their revenue and their profit were to go up, then there is a potential they will increase their dividend. Okay, I don't think they'll bring down their payout ratio to 70%, 80%, because their trend is always like that. Okay, so I don't think they'll stingy enough say, oh, now I make more revenue, I still maintain 18 cents. So because they want to be they want to be a dividend growth also. Okay, so that is why to me is an opportunity on that. Okay, but I look at the chart performance against who? STI. This is their 1 year return. It actually outperformed the STI also. Okay, so STI component, it outperformed STI. And let's look at 5 year. It also outperformed by a little bit. Okay, it's also outperformed by a little bit. Let's look at long term. It also outperformed STI ETF. Okay, it's also outperformed. So it gives me a reason why should I buy STI ETF? Okay, why should I buy STI ETF? Okay, so if I to buy STI, even you look at their ratio is not so healthy, but because of the nature of that business, the nature of that industry, okay, they will be there to continue to grow, okay, to fight. And this is their current share price. Okay, and you can see that the share price is having recovered, okay, recovered since the COVID has started to recover up, okay. But do think of this stock is a very boring stock. What do you mean by boring? You go here, you don't expect to go all the way here. Okay, you look at the 5 year chart, it usually trade within a range. It's always a range bound stocks, but it may range bound slowly go up higher, but you don't expect them to rocket higher. So if we are looking at ST Engineering, okay, as I mentioned, they pay out 80 to 90% of their income as dividend. It work like a REIT, and they got high debt. Okay, they got high debt. And thus, when the interest rate to cut, first thing that you'll relieve their interest, their in debt payment, and this may able to propel the company to go and buy more companies. Okay, by acquisition, keep on buying more other companies to increase their capability, and they may have a potential to increase their dividend. And one day announce an increase in dividend is definitely positive to the market. Okay, so that is on ST Engineering side. Right. Okay. Next, I'll talk about this company. So you can see that the fuel scheme company I talk about is all company that are unlikely to shut down. Because if you are looking for dividend income, you want to have something that is stability. Okay, thus I didn't put those semiconductor like AEM, UMS, micromechanics, all the inside, or even venture. Okay, or even venture inside into the list is that one, the stability may not be there. Like they may not go on like venture when another gone, but the share price fluctuation, all these things, the stability may not be that good because they are more depend on market situation. So we want to look at companies that are really all weathers. All weather means that when market up, market down, you're not affected. And when there's interest rate cut, it's good for the economy. They may even perform better. Okay, they may even perform. That's the rationale on looking at this few counter. Okay, next is SGX. Okay, SGX. One thing about look at SGX is that I always look at this thing. It is a very profitable company, okay, with a gross profit margin 80+%, net margin of 40+%. Okay, not much Singapore company can be so profitable. Okay, not much of the US there is. I think you go and look at Microsoft, Apple. I think all super profitable. Okay, which is why their share price can rocket so fast. Okay, but they are on the tech side. But in this exchange side, you can look at SGX. the margin is very, very profitable. Okay, very profitable. And the bad part is that the dividend yield is never cross 4%. It's always hover around 3%. Okay, hover around 3%. That is the bad part about SGX. Okay. But for stocks itself, I look for anything 3% and above will be good enough in general, as long-term Singapore inflation is about 3%. Long-term, not now lah. We do have long-term wise. So you're buying a stocks that have a dividend got at least 3%. Okay. And of course, then followed by, it must be able to grow lah. You must be able to grow that dividend. And practically you are not that bad already. Okay. And of course, we put aside the capital gain expect. We're talking about cash flow. Okay. And this is what SGX is. You can see that their revenue don't really grow. Okay, it's very slowly. It grow, okay, but it don't really grow very slowly. Where from 909 to 1.1, okay, it actually is more than 10%. It's more than 10%. But you look at the net income. So the net income is from 400 to 570. It is easy more than 20%. Okay, so the income growth is more than the revenue growth. This means that they make even their margin is even better. Okay, and this explains why their margin can be so high. Okay, and you look at their return of equities, it is very, very high also, 30 plus. 30 plus, one of the highest in Singapore stocks itself. Okay, when you look for those growth stocks, US growth stock, of course, 30 is considered low already. Okay, but for this is established company, is return equity 30 plus. You go and look back at just now I showed you the ST Engineering. Okay, why I also like ST Engineering is that you look at their return equity is 20+%. Okay, a double-digit return equity is considered good. Okay, and consistently achieve double-digit over a prolonged period of time is very good. Okay, and these two companies and ST Engineering can achieve a return equity more than 20%, even better. And SGX return equity is 30+%. Okay, that is considered quite great. Okay, so we don't care about what SGX Singapore market small, this thing, but they are constantly on the transformation. They constantly encounter challenge. Okay, they constantly encounter challenge, but ultimately is what show here. Return equity, it really 30+%, and although it got keep 40, then come down to 30, then come back 35, but it's still overall. It very hard to see return equity constantly go up one. Okay, we need to be realistic. But you see a return equity constant go down over the past few years, also no good. But you have go up, go down, go up, go down, finally go up again. So it's still okay. Go back to the original point. Okay. So this is what I also look at return equity. Okay, now let's look at their dividends. This is SGX dividend history. Okay. This one I don't need to plot also because I can just plug in from the website. They are one of the few companies that show their dividend trend. Okay, they have IPOs in 2003. Okay, and of course pre-COVID, that time the stock market is crazy. They also pay more, but after market crash, they back to more realistic thing. Then they start to pay 26 cents. But you look at the dividend have been growing up very steadily. Okay, very steady. If I'm not wrong, if you buy this SGX from IPO, okay, you buy this share from IPO and hold it to now, okay, I think you will not believe the return you're seeing now. Okay, it is crazy return. Okay, it is really crazy return on that, and the dividend I think is more than cover your initial capital. Okay, and let's look at payout ratio. I plot this based on look at payout ratio. So their payout ratios. This is their payout ratios. They have been trying to increase their dividends, and do take note they fall 4 times a year. Okay, DBS, the banks pay dividend 4 times a year. Okay, ST Engineering pay dividend 4 times a year. SGX also pay 4 times a year. some of the REITs or most of REITs only pay 2 times a year. Not all REITs pay 4 times. Most of REITs don't pay 4 times a year. Okay, most of REITs pay 2 times a year. So the stocks side, the dividend frequency paying is even more than the REITs. So you are a dividend player. This is where you can look at it. Okay, so one thing I like about them is that you can see that their dividend have been increasing, but the payout ratio in fact come down. So this indirectly means that the up dividend increasing trend still can continue, even let's say they have a revenue drop, right? Well, if they were to just increase, they just need to increase the payout ratio, but it's still within a healthy range, right? Because their normal range before that is 80+%. Okay, 80+%, and SGX is technically was a debt-free company. Okay, but they start to go on debts. Okay, go on debt. To why? To buy companies. To buy companies as they cannot depend on Singapore stock market. Okay, if SGX still depends on Singapore stock market, I'll say that this share you cannot buy. You're gone one. Okay. Although you say that Singapore exchange cannot close out, but you're gone in a way the government may come into need to support the exchange. But they have tried to transform themselves to more multi-business and multi-asset platform. Where you can do actually you can do forex, you can do commodities, you can do fixed income. Okay, on that, and it's not only on Singapore market, it's on mainly on the Asia side. Okay, they're still on the Asia side, like India, China market. Okay, and this is where they generate different revenues. But to do that, they need to acquire companies. That's the fastest way to grow. And to acquire company need money. And this is where STX start to borrow money. They start to borrow money. And with the interest rate coming down, it is a good thing for them. Because first thing, their borrowing costs has come down. Okay. So to maintain the same interest rate, they can borrow even more. Okay, if they don't borrow more, they just borrow the same, the interest rate come down. Then the gain will be to us as investor. Okay. And this is on SGX. Okay. And let's look at their returns. Okay, this is SGX return. We have a 1 year outperform on STI ETF. Okay, 5 year outperform STI ETF. Long term also outperform. Initially, phase it seems we're on par, but after they start to transform and they start to break away. And in fact, you see STI come down, they go up. Okay, they go up, and now they also long term outperform. So in shorter time frame, longer time frame, they are always better than STI. And the next question is, they pay better dividend yield. All the counter I talk about, the bank stocks, the ST Engineering, the SGX, their dividend yield is better than STI. And STI pay dividend twice a year. Okay, so that is on something that you can look at to it. If you are looking for dividend, if you are looking for a high growth one, then this counter may not be your choice. This counter for high growth one, to me, I don't think that is really high growth stock. Good high growth stocks in Singapore market. Okay, then you may want to explore overseas market. But you are looking for cash flow. Okay, and these are the counter that you can look into it. Okay, so now I'm going to deviate a bit to another counter. This one I will want to use. I don't want to use a chart first. Okay, I want to use I just show you this counter. Okay, because this counter I didn't manage to put it in. But I think, okay, it is not really for long term. Okay, but to me, it's really an opportunity. Okay, for those that want to looking at the opportunity side, let me just share with you this screen. Where's my? Okay. Okay, this count. Yeah, how come cannot get? Sorry, we try. My eyesight not so good. That's why I need to wear a spec. Okay, this company called Genting. Okay, I think this is the stocks that everyone is very familiar with. Okay, however, I do think that for this Genting, I draw some lines. Okay, for this Genting stocks, if you are to buy long term and hold, to be very frank, let's say you buy from IPO to hold, or buy 10 years to hold, you lose money. Okay, you lose money. Okay, first thing they are doing casino. So people take these stocks also like casino. Okay, people also take this stock like casino. They also speculate on these stocks. Okay, it is not ideal candidate for dividends. Okay, it's not ideal candidate for dividends. Long-term dividend stocks. But to me, is that it is an opportunity stocks. Okay, but it's an opportunity stocks that you were not gone. Number one, okay, it will not gone. Unlikely will gone because later I show you the financial numbers. Okay, number two, okay, they have the result that people are disappointed. Okay, and thus cause a big gap down on these stocks. So these stocks, the volatility is definitely there. Okay, but to me that they definitely can recover back. Okay, definitely can recover back. And thus to me it is an opportunity. But that's why if it come down, ultimately you still haven't come up because this is to me is like a gambling stock. But why you invest in it, you still get paid for dividends. Okay, and look at their dividend yield. It's about 3.89%. Okay, 3%. Okay, it is not bad. And why? Okay, this is I using Poet platform. You can see that their revenue have went up. No, they are recovered to almost pre-COVID level already, and the market dumped them. Okay, it's a bit funny, and the market dumped them because the analysts expect them to be even better. Okay, they have not even recovered back to pre-COVID level, and do think no, Chinese tourists never come back. Okay, Chinese tourists never come and flood the whole world after COVID. Okay, but will Chinese tourists ultimately one day will come back? I believe so. One day they will come back. Okay, and then that will be another boost for this counter lah. Okay, that will be another boost for this counter on that. Okay, and so they are still on the path to recovery. They are still not out of the pre-COVID level yet, and this is without the Chinese tourists. Okay, this is without the Chinese tourists. And next is that you are not concerned about they will go bust. You look at their current ratio and good ratio is 5.21, 5.15. That is super healthy. Compared to just now, you look at ST Engineering, it's not even 1. Okay, it is so financially they are super healthy. And you look at their liability is 954 million. Okay, but I look at the money they have in the bank. I just look at cash only. Just look at cash only. 3.6 billion. They own 954 million, but they got 3.6 billion of money sitting in the bank. So practically, you can say that they got no liability. So practically, you can say that they are a debt-free company. Okay, debt-free company and still got a lot of money. Okay, which one they can expand. They're going to expand the resort world further, right? Well, they got money to expand. Okay, they got money to expand. On the end, they can don't even use the money if the interest rate will come down. They can just go and borrow some more at a lower interest rate to continue to grow, to leverage on it. Okay, to leverage on it. And then their interest rate before COVID is their dividend is 4 cents. COVID come, they get cut. Now they are restoring back. So definitely the dividend will be back on the uptrend because when they recover back. Okay. And of course, their return equity is not really fantastic. Okay, not very fantastic. So I say not for retirement, but to me it's opportunity at this aspect, and it also continue to pay increasing dividend. So I'm looking at potential increasing dividend and capital gain on that. Okay. So, but if you are someone anti-gambling one, anti-speculation, then of course, then this counter is not for you. Because I got some kind of, don't recommend getting people. I don't like the thing they do. okay, then of course then it is not on your radar. Okay. So next, there's one question asked: is MLT a good dividend stock play given the exposure to China? Okay. Today I'm not supposed to talk about REITs. Okay, but since you asked it, I just answer that. Okay. MLT play to me is a good dividend stock. In fact, I just added MLT. Okay, for some of my clients that I manage a portfolio one. Okay, I just added MLT for them to the portfolio because I look at the current share price. There is a share price weakness for MLT now. Okay, and they are trading very near to their NAV level. Okay, MLT don't trade below their NAV over the past 10 over years, regardless of COVID, whatever market come down, they don't go below their NAV. That is a invisible support line. Okay, and now they're trading very near to the NAV, which indirectly may imply that that's the bottom. Okay, of course, things may change their radar sign. One day they go below, but that is a past record that they don't drive. So to me, it is a good opportunity to accumulate MLT. And with the interest rate coming down, definitely they have. Okay, but the bad part about MLT is they got China exposure. Okay, they got China exposure. Okay, because China is quite bad, in quite a bad shape now in that aspect. So you want to buy MLT, you must have the faith, believe that one day China will recover. Okay, and the consolation for MLT is that they have China exposure, but they have China exposure on the e-commerce aspect of China. They are not on the shopping mall. They are not in the office building of China, which is affected very badly. And this is why you see CapitaLand China Trust come down, CapitaLand Invest come down, Mapletree Pan Asia Pacific, North Asia, and Pan Asia Commercial Trust, I still all come down quite badly because office building, shopping mall. Okay, but MLT got China exposure because of that. Okay, they are being exposed to it, but because they are on the logistics side, so they are so-called safer. And China exposure about 20, about 1/4 of them. Okay, but they have been constantly expanding other regions. For example, recently they buy some properties in Malaysia, in Vietnam. Okay, so they are actually in a way that diversified more. So the manager knows what they are doing. So to me, it is one of the good REITs that you can think of buying whole long terms, and it pays dividend 4 times a year. Okay, it's one of the few REITs that pay dividend 4 times a year. MLT is one of them, and also they are very transparent in the aspect. Okay, the bad part about MLT is they will call for preferential share or right issues as and when. Every few years they do once. Okay, that is a bad part of that. Okay, but one thing is that if you don't even subscribe to that for MLT, your dividend will still go up. If you subscribe, you earn more, even more dividends. Because for retiree, they ask me what happens if I don't want to subscribe. You buy some of the, I cannot name the name of the REITs. You buy some of the REITs, you don't subscribe. You get worse. They are just like using a gun to point at you. You don't give me money, I make sure that you will suffer and get less. Okay. But for MLT, no, you don't subscribe. They still say I will give you more. Okay, it's just that you subscribe, I give you even more because you got more units. So that is my take on MLT. Okay, hope that I answer your question on that. Okay, now let me continue. Where is my slide? Okay. Okay, let me continue from here. Okay, the next counter. Okay, we want to look at on that is this company called Sheng Siong. Okay, Sheng Siong is not in the STI component stock. Okay, one thing, it is small. Small. It is small compared to, that's not what I talked about them, but it's very big compared to a lot of other companies because the market cap is 2 billion. Okay, 2 billion is not small in Singapore context. 2 billion is a penny stock in US market. but in Singapore context, it is quite a big, significant company. Okay, and 4% dividend yield. Okay, and ratio definitely is healthy. One thing about Sheng Siong is, you look at these dividend payout ratios, it is 70%. Okay, 70%. So what does 70% mean? That they earn $1, they'll pay 70 cents in dividends. Okay, and that is Sheng Siong dividend policy. Okay, that is Sheng Siong dividend policy. They will pay you 70% of what they earn. Okay, of their net income, they'll pay you of the EPS, they pay 70%. So the question is that if you were to buy Sheng Siong, you want the dividend to increase, you have to make sure that their income or their earning per share, otherwise the earning per share keep on increasing. Okay, if their earning per share drop, okay, so thus Sheng Siong do not have really a stable growth dividend rate, is because they fix 70%. So in a way that they don't, because payout ratio can use it to manipulate dividend payout. Okay, for example, some of the US stocks, okay, they can call themselves dividend king or dividend aristocrat, pay dividend for 25 years, 50 years. Okay, what they do is they manipulate the dividend in a way that if they cannot pay, they just increase more payout ratios to keep you happy that pay you dividends. And some even worse, that they go and borrow money to pay you dividends in crisis period, just to maintain their status. Okay, but for Sheng Siong is that dividend will not be manipulated because they fix 70%. So it means that if they earn lesser, you get lesser. If they earn more, you get more. Okay, so that means that the interest become more aligned in the aspect, and this is on Sheng Siong aspect. Okay, and one thing, they are on the defensive side, they are invested, but the impact is on interest rate. To them, there's not much impact because practically they are a debt-free company. They don't really have debt. Okay, but if your interest rate were to cut, people have more money, spending may increase. Okay, people spending may increase, it may indirectly benefit Sheng Siong. If the economy were to boost, more foreign workers come to Singapore, you also benefit Sheng Siong, because Sheng Siong is supermarket. Okay, and we know that Singapore population will continue to grow, and more housing estate will be built, and there will be more and more Sheng Siong store going to open, and that will definitely be the revenue boost. Okay, but the margin is pretty standard one, but when there's more and more shop, the margin is not really that great. It's about 10%. Okay, about 10%. So if they can sell more, they'll earn more profit. If they earn more profit, you got more dividends. Okay, and this is the defensive stock, is that we know that when COVID comes, Sheng Siong share price shoot up. Okay, because that's where people can buy things. And let's look at the share price. Okay, okay, this is STI ETF. So you can see underperform STI ETF, which I put it at the last. Okay, they perform worse than the STI ETF. Okay, and by look at 5 years, they perform much better. Why? Because thanks to COVID. But COVID over already, the past 1 year, they underperform, right? Thanks to COVID, they have a big return, better than STI ETF. And since the IPO until today, it is really a crazy return. Okay, it's a really crazy return for Sheng Siong on that. This include dividend. Okay, on this aspect. Thus, if you want something that is defensive or weatherproof, of course, they also have went to China. Okay, some women may have Sheng Siong also go to China. Sheng Siong go to China to do what? Open supermarket. Okay, I think they go to Kunming there, open supermarket. But that one is still a very, very small very tiny percentage in that. Okay, will they finally succeed in China? We don't know. Okay, that is called a risk factor there. Okay, a risk factor. Will they succeed? But if they don't succeed now, it is still okay because it's too small. The exposure is too small. But if they were to able to grow bigger and bigger, most likely they succeed, then they will able to grow bigger and bigger. So to me, the risk is very well managed for that. Okay, and that is on the Sheng Siong side. So now let's look at this chart. Okay, for Sheng Siong chart. A lot of people keep ask me Sheng Siong can buy or not. I would say that let's monitor. At the time I told people go below 150 can consider. Actually, then you go to 146. Okay. You can see that the good old days for Sheng Siong have over. Okay. But pre-COVID, I think they are trading about slightly about $1. Okay. Then they can go as high as 180 something, right? Okay, but will they go back to this 180 something? I doubt so. Not in the near term. But will they go to pre-COVID level of $1? I don't think so. I don't think so. So Sheng Siong, you'll be trying to find a good bottom. Okay, then they'll stabilize there. Then they'll stabilize there. But of course, unlikely they'll go back too fast. So it take a while. And maybe at this juncture, you can start to look at Sheng Siong also. Okay. They may have catalyst for them to start to make an upturn up. You just need to look at their earnings result. Okay, so that is on Sheng Siong. Okay, now let's look at all this stuff. I don't have Genting. I don't have Genting stock because Genting is, to me, is like opportunity. Because I look at it, it's really opportunity. This is why I want to share on that. Okay. So these are the stocks performance. This is STI ETF. The one that underperformed STI ETF is Sheng Siong. Okay, but to me, that's short term. That's short term side because they need to adjust for post-COVID, all these things. Okay, that's short term. The rest all outperform. Okay, the rest all outperform. The three banks, ST, SGX, all outperform. Okay, and long term wise, everyone outperform. Okay, OCBC on this negative impact. Okay, so we have to understand what happened to China. So China first thing is the property crisis. Okay, it's a property crisis. It's a property crisis. The bank and the property company have collapsed. Okay, property company has collapsed. Okay, and this caused a ripple effect. Okay, this caused a ripple effect. Now Country Garden also run into issue. Evergrande gone already. Country Garden also run to issue. Okay, and now the China. Then next is that the China economy on that. Okay, on this aspect and. Then the China direction of what they're going to do, like for example, they're going to cram down the tech stocks, all these things. So this caused a very negative sentiment on that, and China business may be affected. OCBC have China exposure, okay, China exposure. But the question is, ultimately, I don't think China want to make themselves down. If they want to ambitious to overtake US, they need to back up. Okay, they need to back up, and I don't think they'll be there not doing anything. Okay, so to me that if you want to look at China now, if you have a longer time horizon, if really long time horizon, you may even start to look at tactical allocation to China market also. Okay, so ultimately long term wise, I'm still positive on China, but short term wise, unknown. It's really an unknown. Okay, so it's really unknown, and we're looking at investing for the long haul. OCBC, I think definitely is fine on that. Okay, on this, because first thing, they are not on the property sector, they are the banking sector. Okay, they go there is mainly borrowing money. As long they can manage their bad debt, okay, well, it is okay. Because the only concern is they borrow money, people don't return them. So as long they can manage that one, I think so far all the three banks all manage quite well. All the three local banks all manage very, very well, which I don't think there will be an issue on that. It's just that the sentimental side, people are making, you got China exposure, I don't like it. Okay, that's on the sentimental side, but to me, financially, I don't think there's a big impact. Okay, okay, so FIRE, all are performing pretty good, okay, for that. And of course, long-term wise, no need to say. Okay, runaway leader actually is Sheng Siong. Actually, initially I thought the graph, I also got a shock. Okay, Sheng Siong really crazy returns. Okay, crazy returns on that. These two things, this is total return. Total return include dividend collected. Okay, it's not just purely share price. A lot of people, share price, okay, but share price really go up a lot because Sheng Siong IPO that time is less than, how many cents? 30 cents, 40 cents. Today now share price is $140 over cent. Okay, so it really is a crazy return. So if I look at this one, I need to remove Sheng Siong because Sheng Siong is not there Sheng Siong, and all actually have outperformed. Okay, so all these are so-called the dividend stocks. Okay, but when you look at portfolio basis, some of you ask me if I want to build stocks on SG portfolio, how much should I build? How many stocks? You see, I said that it should be around 10 counter. Okay, then of course you need to plus your REITs. Okay, so some people they can add together also, but usually it will be within a 10 to 15 stocks will be good enough. Okay, it will be good enough. You don't say I want to buy 20, 30 stocks. You want to buy 20, 30, then your performance will be like STI ETF. Then must well go and buy STI ETF. Okay, because don't really have 20, 30 stocks that really outperform STI ETF. So selection is quite simple, is that you always find a counter that first thing they must be good. And you see they are good, which is why they can outperform the market. Okay, so actually it is link one, is an end thing. It will not find a stocks that all time frame beat the market, but the company is lousy. Okay, you see all time frame they can beat the market, you see the company is good. Okay, and this is why they can beat the market. And so for building a dividend portfolio for Singapore stocks, it is pretty easy in a way. Okay, we then need to go and look at the chart. Then after that, then you zoom into the company. Okay, and then after that, look at their dividend trend and payout ratios. So plus the risk is about 10 to 15 stocks. That will be good enough. And some of you say that I don't want too many, I just want 8 also can. Then even best, even better because it helps you to even screen. Then if you send me 8, then of course the 3 banks must choose 1 only, don't buy 2. The 10 to 15, you can buy 2 banks. Okay, that is on how to build a dividend stock. And with the interest rate coming down, to me, that is a positive news to the market. And stock market always move ahead before the news happen. Okay, so if the whole market is positive and on the interest rate coming down, all this, then you should start to position yourself, okay, to start to build your position over time. Like for example, I always say advocate risk is a time that you should start to accumulate, not one time buy everything. You need to accumulate on that, wait for a good opportunity to accumulate. As I mentioned, like that's why someone asking MLT. To me, MLT is a good at a good point to accumulate. Okay, it is to okay, but lose money don't look for me. Okay. Okay. So that is on that. Do remember your own due diligence on that. Okay. That's on the Singapore side. So when you come to a portfolio, right? Even when it comes to stocks and REITs, right? That is we are talking about SG side. So if you really want to look for growth, then maybe US is another part you may want to look at for growth. You don't focus on Singapore for growth, using Singapore for dividends. Okay, you are positive on China, Hong Kong, then you may also want to expose on their stocks here. Okay, and you say that, oh, I worry that tech, all this. You really get looking at tech stocks, Alibaba, JD.com, Tencent, all these things. I would say that must well look at US tech. Okay, must well look for US tech. I think there is more stability there. Okay, more. US is still the number 1 superpower. Like you see, they want to kick out TikTok already. Okay, so they can do anything they want. Okay, you kick out TikTok, go for Facebook. Okay, so then, but you look at this, then you can look at dividends. They got good dividend stocks. For example, the China banks are good dividend play, but also need to watch out because of their debt, because of the property sector. Okay, and this is how you build a multi-asset portfolio on that. Okay, followed by this is the one. Okay, and Singapore Savings 1 888 CPF Life. But do take note, there is changes in CPF Life. Okay, so CPF shielding don't work. CPF shielding don't work. Therefore, only CPF Life for you to move around. And Singapore Savings Bond or even 888 government bond, when interest rate were to cut, okay, they may no longer be that attractive. Okay, so you may also need to see how you need to adjust your guarantee and non-guarantee portfolio, okay, to also to anticipate, okay, for the interest rate cut. Okay, it is good for one part, but it may be bad for some part. So 2 years later, I doubt people will want to talk about T-bills anymore. And I doubt people will be interested in looking at T-bills. Then what is a T-bill yield? I constantly, every 2 weeks, constantly got client ask me what's the expected T-bill use. But I think 2 years down the road, I think nobody will be interested to talk about that. And this is where market is dynamic. You need to, your portfolio, although you build already, is also dynamic. You may need to adjust along the way. Okay. And this is where we call pivoting. You may see how you're going to pivot this one, okay, for a portfolio going forward. And now it's the opportunity for you to start to do pivoting on that. Okay, but ultimately, we are looking at lifetime income. Ultimately, we will retire. You want to have lifetime income, and you really want to have an income. As I always mention, I want to have something called a paycheck and a playcheck. Paycheck is something that I want it to be guaranteed because I need to pay my bills, my food, my transport. So CPF Life is definitely, to me, I'm a strong advocate of CPF Life, okay, because it gives me something that's certainty, okay, whether it's black box or what, but ultimately it's something a certainty in that. And then after that, you look at what other alternative you have that can give you something that is guaranteed, okay. Then from there, then you build this portfolio for longer term for you to play in a way. Go holiday, dining, luxury. When you retire already, please enjoy yourself. Okay. It is quite sad that I see people tell me that they want to retire. They need to sell their house, sell their car. Then they can retire. And then the question I will ask, then we work so hard in your life for what? Okay. When they're so hard in your life, then when you retire, you need to sell house, sell car, downgrade. Okay, so thus a proper planning is required before you retire on that so that you don't face that dilemma on that. Okay, and this comes down to the course I conduct is called the Lifetime Income Mastery. Okay, it is an IBF accredited course where you can enjoy up to 70% subsidies by the governments. Okay, and it's conducted by me, plus I got 2 co-trainers in the class, okay, to help out. And this course I divided into 10 modules. The objective of this course is to talk about different asset class, personal finance, and also then hands-on build a multi-asset portfolio. Okay, then from there you can apply to your own self. Okay, so the first is check out your finance. You should check on what is your personal finance, especially at this juncture now is a good time that you go and check out your finance. See how can you pivot your finance, how can you plan for the interest rate cut, how are you going to adjust your finance situation, how you are going to reallocate your asset investment part. And this is where check out finance come in very handy at this juncture also. Okay, next we're going to talk about insurance. Okay, when talk about insurance, we're not talking about protection. We are talking about protection, we're not talking about universal life endowment investment plan. We're talking about protection aspect. Okay, and we know that we definitely need insurance. Okay, I think nobody will say that they don't need any insurance. They say that when go hospital, they take money from the stock market and pay for the bills. Okay, I doubt there will people do that. You cannot say don't have, maybe there is. But that time the market crashed, to them, they got a lot of money. They say, never mind, they just sell it, lost and pay. Okay, but majority people will do that. So you need certain form of insurance. And we know that insurance cost is not cheap, especially medical costs. It is really crazy. The premium increase is very crazy. So thus we will need to discuss on it is how can you find a cost optimize your insurance premium and get yourself coverage so that in future, so that you got more money to plan for retirement. Okay, next we talk about CPF. Okay, there's no point talking about CPF shielding and CPF strategy for withdrawal going forward as next year, government plug that loophole already. So now we're talking about how to grow your CPF, how to optimize CPF, and what should you look out for, and what can you invest in your CPF money. And of course, you need to protect the downside risk. So this for those past graduates, this module will overhaul compared to your past site. Okay, the structure will be different already. Okay, and next we talk about growing an SIS. Besides talking about SIS, whether is it worthwhile to contribute and what can be invested, we will talk about how to do the withdrawal. the withdrawal strategy, I think is more crucial rather than just talk about growing your money. And how can you withdraw SIs for life? 10 years is the window, but you can also make it a lifetime withdrawal. If you happen to have a lot of money, you grow SIs for money. So there's way to do it. We'll talk about that. Okay. Next, we talk about asset class. Okay. First, we talk about passive income. We talk about fixed income. Of course, we talk about T-bills, Singapore bonds. We talk about Singapore savings bonds. This one we still now can talk about. We also want to talk about next in future, how can it pivot from it? Because you have it now. 1 year later, your T-bills mature. You buy the 1 year T-bill, then what are you going to do about it? Okay, then we talk about bonds. Okay, we talk about retail bond, wholesale bond, professional bond. We'll analyze bond in the class. We analyze at least 2 bonds that is currently in the market in the class so that you can decide whether it's worthwhile to invest in the bonds. Okay, at the end of the class, you're able to use this method to look at the other bonds in the market. After that, we talk about dividend stocks. Okay, we'll talk about value stocks. We don't talk about growth stocks. Okay, we'll talk about value stocks. And at the end of the day, we'll analyze 3 value stocks. At the end of the day, I'll give a list of Singapore stocks for consider. And some of you say that I want to have US exposure. A lot of time, every time I attend a class, some people, how can I talk about US market? So for the going forward class, of course, I will not discuss a US stock, but I can give you a list of US stocks that you can consider to be part of your so-called dividend or growth portfolio for your side. But it will be more of a tactical allocation on that. Okay. After that, we talk about risks. Not all risks are equal. So we analyze 3 risks in the class. We'll show you how to pick risks, how to choose the right risks for retirement. So similarly, at the end, we will have a list of risks for you to bid on it. And I'll also have US risks for you to consider as a form of diversification or as a form of tactical allocation on that. And unit trust. There's about 2,000 unit trusts in the market. And this is where we talk about bond fund. We analyze the bond fund, balance fund, and equity funds. Same thing at the end of the class, I'll give you a list of unit trusts. Okay, you can look at it for cash investment, SIs investment, or what I call it a CPI investment. Actually, my YouTube channel, I'm going to update it on the unit trust portfolio on that because I do a major rebalancing on my unit trust on that. Okay, but I have not recorded it. Maybe April, there are a lot of people are going holiday soon. Okay, then you can watch out for my YouTube channel on the unit trust I'm going to talk about on my portfolio itself, on my live YouTube portfolio. Okay, next, we talk about savings and retirement plan. This is the promise-based asset class, but almost all insurance companies have that. So you may want to analyze this. We'll look at the current plans that is in the market. Then we do a compare and contrast so that you know what should you buy when you want this type of plan. And lastly, we will build a lifetime income building various asset class. But to build this, we need tools. So we need Excel spreadsheet tools. And this Excel spreadsheet tools, so there's a prerequisite. You must know how to use Microsoft Excel. If you don't know how to use Microsoft Excel, please don't attend the course. Okay, and next is the online Zoom class. You must know how to use Zoom. Okay, then you can attend the course. At the end, of course, there's a post-course support with a CQ station. You can join the CQ station where you can post questions there. And of course, I got my YouTube channel. You can go and subscribe to my YouTube channel where actually I got stocks, US stocks, Singapore stocks, and unit trust portfolio. As I mentioned, I'll update my unit trust portfolio most likely in April. Okay, on that because next week I'm traveling already. So April, I'll post my update, especially on my unit trust site. And Facebook page, you can follow my Facebook page. As tomorrow, I got to ask me anything on unit trust and ETF seminar. If you want to register, you can go to my Facebook page to sign up for it. And lastly, on the funding, okay, this is a funding where if you are below 40 years old, you need to pay 50% of the cost. 50% of cost will be funded by IBF. Yeah, above 40 years old, 70% of cost will be funded by IBF. And these are the dates, okay, April and June. And this is a cost fee. So if you are Singaporean below 40 years old, you need to come out 885. You are Singaporean above 40 years old, you need to come out 585. And if you are skill future credit still balance, you can use it to pay. And you are past LIM graduate and you want to re-attend the course, there will be a 50% off the cost fee. for you to reattend. What you need to do, you just need to sign up and drop an email to CyberCode, and they'll tell you how much you need to pay. Okay, that is all on that. Okay, anyone got any question, you can actually contact me also. I think a lot of you actually have my contact also. Okay, if not, Andy, are you there?
Oh, hi.
Yes.
Yes, Darren, I'm here. Can see me and hear me well?
Yes.
Okay, can, right? Okay, great. Thank you. Yes, thank you. Darren, Senior Financial Services Director, and thank you very much for those who still stay on to the end of the session. Like what I will just share with all of you here in the beginning of the opening speech, right? Please stay till the end of session because there will be a lot of goodies going to share with you here. How can you benefit to learn the course? Now, in fact, what Darren just shared with all of you here, it is also very true that as a coming in as a training provider, I always share with those attendees, right, who join in, whether by Zoom attendees or even by last time, even they in fact last time we also have a physical class, so we always tell them, say that the funding support from the government, from IBF, Institute Banking or Finance, or even from SkillsFuture Singapore, may not be stay on forever. So that's a reason why while 4 years back when this COVID pandemic hit Singapore, hit us. So that is the time when government, in this case we call IBF, the video we just played earlier on, which is taking care of on funding support for local citizens and permanent residents. So that times during the COVID time, there is about close to 95% of the cost fee subsidy. Okay, thank you for those who are, thank you to Kong Nam, right, for those who are joining in. Of course, we also wish that those who graduated, right, I think Darren already give a special arrangement for you. For those who graduated for the lifetime income mastery course, if you wish to re-attend the same course, you're able to get a 50% of the cost fee, right? Of course, that one you have to contact us. You have to send to support@cybercool.com.sg, and we will actually do a verified of your attending, and then we will send you a different pricing scheme for the registration, whether for the batch 43 or the batch 44, April or the June intake. Okay. Now, lifetime income mastery course is the course that Darren and running with CyberCodes for easily more than, this year will be stepping into number 7 or 8 years already. Even right before the COVID, Darren already run this course by himself. That is that time I still remember he ran his own, and then after that work with CyberCode, and then we apply to the IBF accreditation, and then 4 years till now is still running, is through the IBF accreditation courses. So last time before the IBF's course fee subsidy, IBF provide this funding support. So when you want to join in for the course, you got to pay a full course fee. Of course, that time the training hours is still shorter. I still remember course participant could pay a full course fee 1,200 with before GST. But now, because I think Darren add on the module, as you can see, there are total 10 modules you're going to learn in this lifetime income mastery course. Okay. Now also, as you can see on the slide, we have a lot of we actually approach a lot of so-called entities in Singapore entities. So of course, IBF is the one we submit our course to get accreditation. And of course, SkillsFuture Credit is one of them for local citizens, as well as we also apply to the NTUC to get the UTAP funding support. So for those who are holding NTUC member also can stay on for a while, because I'm going to share with you how can you benefit using your UTAP credit, to join in for our lifetime income mastery course. So you see, we give a lot of so-called different ways of this support for you to join for this course on top of the IBF funding support. Okay. Now again, allow me to just go through the SkillsFuture first, because SkillsFuture is the credit given to local citizens, and this is the credit that actually given to you, and then that's where you can start to also use the credit to pay for this lifetime income mastery course after the course fee subsidy, which means after the 70% subsidy, 5 or after the 50% subsidy, 5 with GST. Okay, so just bear with me with a short while. Okay, now more importantly, I would like to take this chance to share my screen first, so at least all of you can see. For those who are able to do the registration, if you have been doing registration or maybe make payment using SkillsFuture, you are quite well versed. You can just proceed to there's a link. There's a link under the chat. There's a link has been sent to everyone. Just go to the link and click the short link. You will come to registration. But for those who are first timer, to get to know for this lifetime income mastery course, just bear with me. So I'm going to run through with you step by step how to use the SkillsFuture credit, PayNow, PayLah online payment to make payment, as well as the NTUC UTEP funding also. Okay. So let me just share my screen first. Okay, let me just share the screen. So yeah, just need to share. You can see my screen. Okay, cool. Right, you can see my screen, and then you see when I click the chat. Sorry, this is the chat. This is the chat I sent to everyone earlier on, right? So under the chat, there's a link there. Okay, Gongdam, thank you very much. Right, there's a link there. Click on the link. This is the only link will come to the course registration. So earlier on, like what Darren mentioned, this will be the online class. So online class, basically, you need to have a PC. You need to have a PC to join for the course, right? So that is a mandatory requirement, right? So a computer laptop is a requirement. And then, of course, also because this class, lifetime income mastery course, is also require the course participant to, when you have a PC to join for the class, make sure that your PC also equipped with the Microsoft Excel, because we're going to use that Excel platform very much to do join for this course. Okay, so make sure that when you join in for the class with the laptop, you have the Microsoft license in your PC. Okay, so click on the link, you'll come to this page. So we have the header, LIM is a quick name for Lifetime Income Mastery. So in short, LIM course registration form 2024. So you mouse over to selection of course date, click on the drop down list. So over there, you see there's a two different course date. The first one is the April batch, which is the batch 43. And then the second one on June will be the batch 44. Right. So of course, I assume that you can attend for the first batch. So you can see the setting of the class is what in such. First 2 day, 18 and 25th April is on the Saturday. Sorry, it's on the weekday evening. If I'm not wrong, should be on the Thursday. Okay, 7 p.m. to 10 p.m. in the evening. And then the next 2 day, 20th, 27th April is on Saturday, 9 a.m. to 4:30. So it's 2 evening and then 2 Saturday. Okay. Now over here, we also have the field applicant. So most of the field is required field with asterisk. Please fill it up as required. And then make sure you select the self-paying participant, right? And then we'll let them make the cost fee payment. So make sure you register, also make the cost fee payment. And then over here, it will explain to you the full cost fee is 1,500 with the 9% GST. What is the funding here, which is already shared by Darren earlier on. Now, over here, we also have the payment methods. So we provide 4 different payment selections. So the first one will be the SkillsFuture credit, followed by Visa Master, followed by PayNow, as well as PayLah. So we have 4 options for you to select to make payment. Okay. Now we start with the SkillsFuture credit. Now, officially, SkillsFuture credit, it is for local citizen. You have your SkillsFuture credit, right? So this SkillsFuture credit, you need to sign in with SingPass. So if I select SkillsFuture credit and mouse to here, right beside this word SingPass login required. You have to make sure you have the SingPass app in your mobile in order for you to sign in. Okay, click here. Once I click here, you route to a page. You route to a landing page of the SkillsFuture page, and you can see our course, Lifetime Income Mastery, will be appear within the landing page of the SkillsFuture portal. Right, this is a SkillsFuture portal. A course name. You capture a full course fee. So I need to click on the e-services. Right. Once you click on e-services, you pop up 4 or 5 different boxes. So I click on the first box, check claim SkillsFuture credit.